But let's bring on board Santosh Rao and talk about what he's making of the global market construct right now. Santosh, hi, morning. Good to have you on the show. More inflation and labor data, I guess that's what investors are bracing for. But how is it that you've read into the inflation print, and does it seem like a September rate cut is pretty much par for the course now?
Yes, in fact, after today's data, I think it's 25 basis points is par for the course now. But down the road, there is some chatter that he might continue to raise rates. I mean, cut rates rather down the road. So maybe two or three. So I think that's good. I mean, anytime you cut rates, it's good for growth stocks. It kind of gets less restrictive. The housing market picks up. The mortgage rates are down quite a bit. So I think a lot of things depend on these rates coming down. So I think that's a good sign. And today we saw the NVIDIA CEO at the Goldman conference. He had some good commentary on the semiconductor space. So I think that triggered the whole rally. And NVIDIA has always been the leader of the pack. So the semiconductors rallied there as well. So I think, and overall, I think after we digested what Jamie Dimon said yesterday or the day before, I think it's not that bad. He said that the margins are down as the interest rates come down, the net interest margins come down. So I think overall the banking sector is going to be under pressure. But I think people are saying it's not going to be that straightforward. There are other issues. I mean, for the banking sector, the whole slowdown going towards recession, if there is one, I think that's a negative. So that could have played into the banking sector selling off. But overall, net, I think I was listening to your IPO commentary just now. I wish we had that here. We don't have that animal spirits here. We want that badly. IPO market is pretty much dead. So we don't have, but we have something big coming up. It's the uncertainty of this election that's really putting a cap on any enthusiasm on either side. Because we don't know if the Democratic, if Kamala Harris comes in, she's talking taxes, she's talking tax on unrealized gains and all that stuff that is really counterproductive. And here Trump is talking about less taxes and really pumping up the economy on this side. So I think the market is waiting. They don't know which side it's going. The debate did not settle anything. Maybe it was on the optic side, but on the real substance side, it didn't settle. So the uncertainty stays. I think that's what's holding back the market. So it's going to be up, down, unpredictability. That's the word I heard also from you guys. So it's really, you can't really make a call as yet.
So from a market standpoint, which do you think, what election verdict could be a better verdict? I'm just purely talking about from a financial market standpoint. Democrats coming back or Republicans coming back?
I'm biased. I work on Wall Street. I think Republicans coming to power, I think will be much more beneficial. We've seen what happened in the last 3 years and how they've handled all the inflationary issues, and they still want to pump more money, want to put more free money into the system and all that stuff. That's really inflationary, and they're not stopping there. So there are a lot of social programs, a lot of feel-good stuff there. So I think Republicans are more, I mean, they have their own things. I mean, they feel they cut taxes. I think it'll spur the economy and get the revenues up and all that stuff. But I think that'll work. And also, Trump is more unpredictable, which is good for the foreign affairs side as well. So I think on the war side, all this going on, that will put a damper on that thing. I think it'll really control that. So net, looking at both sides, they're both good candidates. But I think Trump is where I think will be more beneficial than Kamala Harris if they come to power.
Santosh, I'd like to draw your attention to what is happening to the commodity complex and something which is not adding up, which is that why have commodities, I'm talking about crude, base metal, they have actually plunged, and they are coming down at a time when dollar is weak. The historical correlation is rates go down, dollar goes down, commodities, they go up.
Yeah, I think that's again playing into this recessionary talk, this slowdown talk. I think that's what you're seeing. There's and on the oil side, I mean, US is pumping. I think they're pumping record levels of gas here. So there is supply. There's a lot of supply, even though OPEC wants to cut. there is tremendous supply. And Guyana is going to come on board and all that stuff. So net, the supply demand imbalance there, that's keeping the price down there on the crude side. Then also you have the geopolitical, so there's cross currents there on the oil side. But commodities, I think things are generally expected to slow down. The economy is expected to slow down. That's the building narrative right now based on the data. And I think at some point it will correct. But at this point, I think at least until the elections, let's see where that goes. I know the Biden administration had a lot of fiscal stimulus that really powered up the commodity space. I think that's going to either stop or go either stop or come down quite a bit. I think that's going to put a damper on the commodity complex. So all those things are playing out there. So net, I think it's more about demand or the expected demand that's really pulling commodities down.
All right. And what do you believe is really going to be on the mind of the Fed when it comes to the inflation trend? Is it going to be more focused now on economic growth? Just a quick word.
Yeah, absolutely. I think Fed should be happy. This is what they wanted. They were slamming the brakes. They wanted to slam the brakes, and they got what they want. They slowed down the economy. They really took away the excesses. The consumer slowed down, but by not much. The job market slowed down, but not totally. So everything is, I think we're talking about a safe landing, smooth landing, whatever you call it. So I think that's what we're looking at right now. And that's what the Fed wanted. That's the best of scenarios that they can hope for. So at this point, they don't want to go too deep, become too restrictive again, and on the other side. So let's see if he can maneuver it. He's definitely looking at the growth side. He knows that it's slowed down, but he's more worried about the employment. He's not worried about the inflation. He knows it's on the glide path to 2%. That's his target. It'll come down. It's definitely going there, up and down a little bit here and there. But he's more worried about full employment, which is his second mandate. And there he's going to keep a close eye on that. So if the next employment data is very strong, or very weak, I think that's going to be very illustrative of what he's going to do. He's going to be data dependent. For this one, he's definitely 25 basis point, but he's going to really watch what's going on for the rest of the year. And you'll have election behind him at that point. So there's a lot of, I think election is the big big obstacle in here. People want to see what's going on there. And even though they say they're independent, I'm sure there is an eye on the election side as to they don't want to disrupt the election process based on interest rates and all that. So even though they say they're independent, I think there is some wink, wink, nod, nod that goes on there.
I'm sure it does. Santosh, good to have you on the show. Thank you so much for taking the time out.
Thank you. Thanks for having me.
If you like this video, then like, share and subscribe to ET Now.